Today, the economy and the markets are driven by the central banks, three big forces that are at work that have not existed in our lifetimes before. And they are a long-term debt cycle, and we've reached the part of that cycle where interest rates are at zero and monetary policy is a major driver. What this looks like in a world where we're going to print a lot of money, monetize debt, and so on. The whole world cycle began in 1945. That was the beginning of the New World Order. 1944, we established the dollar as the world's reserve currency. It was connected to gold. And then until 1971, that broke up. And so there was an arc in which central banks have the capacity to produce demand by producing credit. Just sort of hit a button and poof, and demand rises because credit comes out. But when interest rates no longer are effective and hit zero, as they did in 2008, you go to a monetary policy, which I call monetary policy 2, which is the printing of money and the buying of financial assets. And with that, there was the implications of that. Lots of liquidity in the world, bidding up asset prices. And we had an environment which was very good for capitalism, corporate tax cuts. All of that caused asset prices to rise. And then, of course, it also contributes to the wealth gap. Periods of prosperity that occur after wars, during periods of peace. There are periods of peace because there's a dominant power that no one wants to fight, and you have a prosperous period. And during those periods, there's a lot of development of credit, a lot of also expansion of prosperity and so on, technology development, and that creates wealth gaps. And those wealth gaps, and then along with those wealth gaps, values gaps and political gaps develop. So our wealth gap is now the largest since the 1930s. And the political gap is also very large. And so that influence is a giant influence. So that's number two. And then number three, as the major influence, is the rise of a great power to challenge the existing world leadership of the United States. And these cycles have happened over periods of time. That competition, that wars of various types, trade wars and the like, is another factor. So those factors are in place and were in place before we had the coronavirus. Today, the economy and the markets are driven by the central banks, coordination with the central government. What I mean by that is the purchases right now of financial assets by the Federal Reserve or the purchases by the Federal Reserve of government securities are the drivers. And the central banks will take that debt on. They'll own it. And they have a political agenda, not an economic agenda, in which they'll determine whether they'll be paid back or when they want to be paid back based on how the economy is doing and what will happen. So those are markets which are driven by central banks, not only their actions, but their desire to be an owner of those assets, and their priorities about that ownership when they buy and when they sell are not the same as the classic free market allocations. And as a result, the capital markets are not free markets allocating resources in the traditional ways.
Before we continue, help us by smashing that YouTube like button and subscribe now to this channel. This shows the algorithm that you value the information, and it helps us spread this message. Sharing is caring. Please like and subscribe now. Thank you. And now, let's continue.
I think the important thing to understand is that there's a real economy, and then there that has a supply-demand of stuff. There's a financial economy that has its supply-demand of money and credit. The price of an asset will equal the risk-free return, which you can see is something close to zero, and a risk premium. In terms of equities, you have to ask yourself, what will the premium be for equities? And the money competes for getting returns. And so if you ask yourself, what could the risk premium be, or what would the expected excess return for equities be over cash, and they buy assets, that number could go from 4%, let's say, to 2%. The PE is just the inverse of that. So just by way of example, you could make the PE go from 20 or 25 times up to 40 or 50 times by the demand. That may seem implausible, but that's just because people have sticker shock. But it's no less implausible than zero interest rates. So the risk premium will be driven by the amount of liquidity put in, and multiples are not shouldn't be used as in the traditional way of a frame of reference. I think you have to understand that the capital markets drive the economy and the PEs and the risk premiums more than the real economy drives the capital markets. You don't want cash because, and I don't think you want bonds, because you get no interest rate. You get a negative real rate, so you get taxed at that negative real rate. And then, so from a holding point of view, it's got no return. And then the central bank's going to print plenty more of it and produce its supply. And if you look at history through times, it's basically almost the reciprocal of the value of money. And we see that from financing. You know, when you think a company or an individual thinks I could borrow money at this level and I can lend it at that level, or I could buy my stock back at that level, you see that kind of movement. And so through history, sees that there are different storeholds of wealth that are basically almost the mirror image or the reciprocal of the value of money. You realize that they have to put liquidity in the system. Then it's equities, it's gold, it is what is the thing that is the reciprocal of the value of money. March 1933. Same thing. August 15th, 1971. Nixon. Same thing, the values. You could see it when Mario Draghi in 2012 said, we'll do whatever it takes. You produce liquidity and you produce money, and that creates the bottoms in those markets, because really you're dealing with a liquidity issue.
What to do in such a situation? Inform yourself and keep your financial education strong. We from the Compact Group offer our loyal subscribers a free educational portal with first-hand monetary, financial, and economic knowledge. Enter our invite-only Insider Club by clicking the link below. You will get access to first-class information far earlier than the rest. We have prepared a special deal for all our members, where you can access a giant pool of Robert Kiyosaki's financial wisdom for just $1. To find out more, simply click the link below and join our Insider Club absolutely free. But there is more you can and should do. Build up several streams of income. More and more people realize that they have to take their future in their own hands, but they don't know how and where to start. We from Compact offer our Insider Club members unique opportunities. Strengthen your financial muscle and get the edge. Click the link below. Become part of our free Insider Club. No financial obligations. But there's one important thing you have to know. You have to become active. So do it now. Become active, and see you on the other side.